And then we're going to have one of our upcoming topics is someone from the telecom industry is going to come and talk about ways that businesses can kind of adapt to this too, because there's a lot of increased need for broadband access. Even with people working from home, they still have to back end access into the server at these businesses, and there's some ways that you can kind of optimize that. And I think they're going to address the whole 5G is causing the coronavirus weird theory out there. So, but that's another one that's coming up. And I'm not sure if they're going to be on Monday or if they'll be the following week. But we have some other good things coming up. So please try to join us Mondays and Thursdays at noon.
Very good. So Austin, I've got your presentation downloaded. We'd like to thank Austin Duke for joining us today. He's with Edward Jones, and he is the newest member of our board of directors here for the American Fork Chamber of Commerce. I don't know what happened. The moment that Austin became a board member, we haven't had a board meeting since.
Thanks, Austin.
Actually, we did, but he was off building houses in South America for the last one that we had, but then we had to cancel our March one, and we haven't had one since. So, Austin, we're going to blame this whole thing on you. No.
I'm okay with that. That's fine.
So let me, if you want to introduce yourself, maybe tell us a little on your background, and then just tell me when you're ready for me to share that screen, and I'll bring up your presentation.
Sure. You can share it at any point. That should be fine.
Okay.
But as Josh mentioned, I'm Austin Duke. I'm with Edward Jones. Been there for a couple of years. Before that, I've actually been in the financial industry for since 2007. Started with Zions Bank doing commercial lending, which was fantastic for about 6 months. And then the recession came through, so that was a difficult time. But went back to school, did a master's degree in finance at the University of Utah. Spent a couple of years at Morgan Stanley, then as a portfolio manager for an advisory firm in Orem. And I also have the CFA designation, which is Chartered Financial Analyst. So it's basically just education and experience above and beyond what some of the basic requirements are for financial advisors. But the presentation today was produced by Edward Jones. There's a lot of information in there. I don't intend to cover everything because I want to keep it brief, and I want to keep people's interest level high. So Josh, I guess you'll be scrolling through, and I'll just let you know if we need to advance or
yeah,
we're going to stay on one or not. But it's entitled Outlooks and Opportunities, and it's called The Investment Puzzle: Putting the Pieces Together. When I saw it come out recently, I thought it could just be a really good way to talk a little bit about what's happened in the economy and the stock market, and what we're seeing as coronavirus is, and the government response to coronavirus has taken a hit to everyday life, and then what we're seeing going forward. So again, I don't intend on talking about every slide in this deck, and hope that everything will be wrapped up within half an hour. And if anybody has questions, I'm happy to answer those as well. But
and we do encourage everyone to, if you have a question, you can either unmute yourself or more preferably just type in the chat. And then if it's a question pertaining to what he's talking about at the moment, we can ask that right then, or at the end, obviously we can have a Q&A session as well.
All right, so if we can go to the first one, Josh, or the next one. So these are the different puzzle pieces. These are the questions that we'll cover today. So is there going to be a recession this year? Are interest rates going to go lower or even negative? How long will the market slump last? Will global markets keep underperforming? What impact will politics have on the market? What are the risks to our outlook? And what common mistakes can I avoid, and put all the pieces together? So on the first, if we're going to go to the next one, will there be a recession this year? My answer is probably. We could very well be in a recession right now. It's mostly, again, related to the government response of asking people to stay home or just shut down their businesses. A lot of people who are either unemployed or they're not making as much money. So the likelihood that we're in a recession or will have a recession declared is high. On average, recessions last 11 months. The shortest one that we've had since World War II was in 1980, and it lasted 6 months. So depending on how quickly we're able to get out of quarantine and back to work, this could technically be the shortest, but it still remains to be seen whether or not that's going to happen. If we can go to the next one, Josh. So when we talk about a recession, I guess the textbook definition would be 2 consecutive quarters of negative GDP, and GDP stands for gross domestic product. It's basically what we're doing as an economy for consumption on the chart. Consumption is about 2/3 of our economy, 2/3 of our GDP. And so as people have jobs and they're making money and they're out consuming, then GDP can be positive. If people are not working or they have less money or they're more concerned about the ability that they're going to have to make the necessary payments for toilet paper and other things that are scarce these days, then they're not going to be out consuming as much. And so we would see a decline in overall GDP because people are still going to be consuming. They're just not going to be buying more things because they're not making more money than they had been. Business investment is the other category, or large category, makes up about 13% of our GDP. And if businesses are not confident in investing and hiring employees, then we'll see a decline in investment as well. Government spending, we might like to see that come down a little bit, but chances are they're still going to spend regardless. But the institution that will declare the start and finish of a recession is the National Bureau of Economic Research, and their definition goes beyond just 2 quarters of negative GDP. They're going to look at employment, they're going to look at industrial production, and they're going to look over the whole economy and see what other elements are declining before they will say it started or it's ended. But chances are by the time that they say we had a recession, we'll already be on our way out of the recession. So we're most likely in it right now. How long it will last remains to be seen, but there's that. So let's go to the next one. So unemployment, if in an ideal setting, I was going to start drawing on these charts because unemployment has already started going up. We've seen 16.7 million people file for unemployment just in the last 3 weeks. And the unemployment rate has gone up to 4.4%. Unemployment comes out once a month at the beginning of the month, so we won't have another reading until the beginning of May, but that most likely will be much higher than 4.4. Just because of all the people who are filing for unemployment right now. But that's really all I have to say about that one. So we can move on from there. So the Federal Reserve has two jobs, two mandates. One is to make sure inflation stays in check. The other is full employment. And so there's a few ways that they do that, and we'll talk about that throughout the presentation. But basically, back in the 70s, you can see on the chart the spike in inflation. We for those who were around during that time, it was not pleasant, and we don't want to have that again. So the Federal Reserve is trying to keep it to the level of 2% on average every year for inflation. But we're talking about food, gas, housing prices, medical costs. I mean, there's a lot of things that are incorporated in there. So when they have a difference between core and headline inflation, the headline inflation includes everything. They take out food and energy costs to have the core inflation, which has never really made sense to me because I'm still going to be buying food and gas for my car. But they're a little bit more volatile elements, and so they try to pull those out to make it not look as bad. But so for the most recent past, the Federal Reserve has done a good job of keeping inflation about that 2% level. But we'll see what happens now that they're going to start injecting the economy with trillions of dollars through the stimulus package that they've announced. All right, let's move to the next one, Josh. Business investment, as we mentioned, it's a significant part of GDP, but not as much as individual consumption. But even in 2018, we had the President Trump tax cuts that led to a lot of business investment, but you can see through 2019, it was declining, and presumably now in 2020, it's gone negative, or even further negative than where it was a year ago. We can move on from that one, Josh. And then the recent housing market. So the housing market was doing well. Chances are those graphs will start going down in 2020. I've been talking with mortgage brokers about the lack of funding for people who are trying to buy or refinance their homes, which should ultimately translate into to fewer homes being built and fewer permits being sought after. Christina mentioned the call with Brandon Fugel last week. He was talking about the commercial side, and those who have permits are moving forward in the building process, but fewer permits are being issued at this point. So we'll most likely see a decline in that activity, both in residential and commercial toward the middle to the second half of the year. But yeah, let's move on to the next one, Josh. All right, so interest rates going lower or even negative. I don't know how much you guys are concerned about interest rates going lower or negative, because when we talk about interest rates, there's a whole bunch of different kinds of rates that are out there, and unfortunately, these are not mortgage rates that we're talking about, because that would be fantastic to get paid for taking out a mortgage. But this is basically an interest rate is a measure of risk of whether or not I think I'm going to get my money back as a lender. So if you were to go and get a loan from the bank to purchase a car or a house, they're going to take a look at your income, your credit score, and basically assign an interest rate that they say, that's their probability that you're not going to pay the money back. So those who have good credit scores and high income tend to have lower interest rates, and those who are less creditworthy will have higher interest rates, so that if you do end up making the first year of payments but then default and don't pay the loan, they'll at least have made some money on the loan. If you'll go to the next slide, Josh. The Federal Reserve has an interest rate that they set, and this is one of the ways that the Federal Reserve tries to maintain full employment and keep inflation in check. So they assign an interest rate to money that they lend to the banks, right? So Chase Bank, Wells Fargo, every bank in the United States will borrow money from the Federal Reserve at this interest rate, and they'll turn around and lend it out to us as consumers. So if we want to have an economy where we've got access to capital, then the Federal Reserve will lower this interest rate as an incentive for banks to borrow and then lend it out to us and to businesses. But with that comes higher inflation. So it's a balancing act between what rate do we have, the Federal Reserve rate versus how much inflation that we're going to want out there. So this chart is showing the interest rate that the Federal Reserve charges to banks over the past 25 years, and you can see it's not a perfect science, but it's a balancing act between how high or how low to have it. And a lot of times you'll see if the rate starts coming down, it's because we're seeing an environment where we think a recession is coming, but we're trying to give more money into the system so that people will be incentivized to go out and invest. But it doesn't always work. So anyway, let's go on to the next one. So the question for this puzzle piece was, will they go negative or go lower or even negative? And that's actually not referring to the Federal Reserve rate, but it's referring to the interest rate for as an investor. If I was to go and purchase a treasury bond from the U.S. government. And so on this chart, this is showing the interest rates that have been on the 10-year U.S. Treasury bond for the last 20 years. And again, if I was to draw on this chart, it's actually gone even lower than what we have here on this chart. For the countries like Japan and Germany, their rates are actually negative, which means if I were to give money to Japan or to Germany, when that 10 years was up, I would receive back less money than I gave to them in the first place. There's not a lot of good information or good research to suggest that this is helpful, but it happens somehow nonetheless. So I don't profess that this is my expertise on interest rates, but the Edward Jones opinion and outlook is that the U.S. rates will not go negative. They think that the Federal Reserve has other methods, and so we won't get sucked into that negative rate environment. Let's go to the next one, Josh. We have budget deficits every year in our government, and this chart is basically showing that foreign investors, foreign countries are financing a lot of that debt, which has gone from 0% in 1970 all the way up to about 17% now. So there's that. I wasn't planning to say a whole lot more about it, so let's go to the next one. So this is where I've been spending a lot of my time the last 2 months. As Josh mentioned, I went to on a humanitarian trip, which was 2 days after the market peaked on February 19th, and I was feeling pretty good about taking a week to go to Guatemala and just, not think about myself, but try to focus on other people. And as we'd get back to the hotel, every night I was seeing the market was down every single day, and there was this coronavirus thing that they were talking about, and I was trying to understand, how is this actually going to affect, why is this driving the market down? And I get back the first week of March, and I was talking to people, and they were freaking out, and just trying to understand, like, what are we really dealing with here, and what's going to be the true issue. And I mean, we deal with illnesses and flus and everything every year, and it doesn't seem to have that big of an issue on the economy or the stock market, but for whatever reason, this one had a profound impact. So over the course of about 1 month, the stock market dropped 35%, which is not something that is very common. Since that point, on March 23rd, stocks have come up 28%. So if you had been able to get in on March 23rd, you'd be feeling pretty good right about now. But to get back to the same level that we were on the 19th of February, we'd actually need to be up 55% from that low point. So we're only about halfway from where we were when we had the market peak. If you'll go to the next slide. It's all about earnings. I mean, we look at companies like Delta, we look at the hospitality industry, and we're seeing people that are not traveling, they're not going on cruises, not staying in hotels, not going to restaurants. That's obviously going to affect their earnings. And so if we're investing in stocks, we're doing that because we're anticipating higher earnings or higher revenue in the future. And for especially those sectors of the economy, we're not anticipating higher earnings. And so until we get past all the coronavirus and then we get to the point where we feel like there's a good outlook for people coming back to work, generating revenue and generating earnings, we'll probably struggle to get back to where we were a couple months ago. All right, Josh, let's go to the next one. So kind of an interesting just piece of information. This is taking a look at when the stock market has had a return of 20% or more in a calendar year, and those are the green bars. The gray bars are the next year and what has happened in those years. So most of the time, at 75% of the time, the stock market's up the next year. About 25% of the time, the market goes down. And at the very end of the chart, we could draw another bar for 2019 of 30%, and then a question mark for 2020. But on average, the average return for the year following is about 11%. So the good news is we had this downturn at the beginning of the year, so we've got the rest of the year that we can have an amazing market, and we still be positive for the year. Let's go to the next one. All right, so global markets keep underperforming. Let's go to the next one. We want again, I don't know how interested you guys are going to be about global markets. For this one, it's kind of an advanced topic. Basically, if you were to invest in a company that was based in Japan, the value of your investment would be affected by the exchange rate. And so this chart is basically saying that these companies and foreign countries have done well, but because the U.S. dollar, because of the exchange rate, the U.S. dollar has been strong, the overall return of your investment has been lower. So if you want to invest internationally, you want the dollar to be weaker. And with President Trump in there and the trade policies that he's introduced, that just hasn't happened. So we'll move on from that. And then China has obviously become a bigger component to global growth, from about 2% 30 years ago up to about 17% of global GDP. And they've also been a target for President Trump recently too. So that's all I really have to say about that one. We can move on to the next. So global manufacturing PMI stands for Purchasing Managers Index. This is basically just looking to see what we're producing as a globe, as a world. Because if the majority of GDP is consumption, whether it's individual or business investment, we want to see are things being manufactured, are they being made? So if it's above the red line, then it's expansionary. If it's below the red line, it's contractionary. And we generally would anticipate contractionary environment for manufacturing to be something that we'd see prior to a recession. The red arrows are pointing out times where we've had contraction, but not necessarily an impending recession. And so at the end of the chart, or on the right of the chart, the question mark is, will this slowdown in manufacturing lead to a recession now? But let's go ahead and move on to the next one. So for politics, we're in an election year, so we get to talk a little bit about how politics affects the markets, if at all. So let's go to the next slide. It's kind of an interesting graph. This is consumer confidence, or basically how do people feel about life in general and how they're going to go spend their money. So on the left side of the chart, you can see as the recession was going on, consumer confidence was declining for all political parties. And then in 2008, we hit a bottom when President Obama gets elected, and Democrats feel like everything's great and wonderful. Republicans, not so much. 2016, a very stark reversal of that, as Republicans feel great and wonderful with President Trump in office, and Democrats not as happy. Independents generally middle of the road, regardless of who's in office. But yeah, so we'll see what changes come about in November. Go ahead and move on to the next one. So it doesn't usually matter who's in office or which party is in office. We generally will see positive returns in the stock market during a presidential cycle. So first year, about 8.6%. Second year, 10.5%. Third year tends to be the best year for the presidential cycle. And last year, we had 30% return in the stock market. So that held true for President Trump as well. In year 4, on average, still 9.5%. So we'll see what happens there. Let's move to the next one. And these all pretty much say the same story. So following an election, the yellow line, if the incumbent wins, the stock market generally does better. If the incumbent loses, the market's still positive, but just not as much. It appears that we'll have President Trump and Joe Biden going head-to-head for the election. As far as any uncertainty in the stock market, for those that would remember or were paying attention, when it was Trump and Hillary Clinton, there was a lot of question about whether or not the stock market would go off a cliff if President Trump won the election. And I was watching the on election night and watching the market go down as it looked like he was going to win. And then eventually it turned around and came positive. But with both President Trump and Joe Biden having been in the White House over the last, I guess 12 years between the two of them, we pretty much know what we're going to get regardless of who's elected. So there shouldn't be too much uncertainty in the stock market as far as what policies are going to enact when they're in office. So we shouldn't see as much volatility around November like we've seen in years past. And then, the next one, again, 12 months leading up to an election, we see positive returns. 12 months after, we see positive returns. So the main message for politics is there's not a lot of influence there, and to just be invested and not really worry too much about who's president. So we'll move on to the next one. So some of the risks associated with our outlook. Let's go to the next slide. One of the biggest ones is corporate debt levels. As we mentioned, interest rates have been very, very low. So corporations have been incentivized to borrow, and they have borrowed a lot of money. So one of the risks is, if we had a recession that developed over time and companies could systematically start cutting expenses as they needed to, it would be one thing. But for the economy to shut down the way that it has is going to leave these companies with debt payments they have to make, and presumably less revenue because of everything that's going on. So one of the risks that this could potentially be a longer recession, if we end up in a recession, would be the debt levels that corporations have. I know that there are, we're trying forbearance for people that are renting to not have to make their April rent payments. Not sure that creditors would be as forgiving to corporations who have debt payments to make, but we'll see what happens there. On the next slide, we'll talk a little bit about the U.S. budget deficit. That first yellow bar was the estimate for 2020, which we could basically draw a line all the way up to the top of the chart now that we've got stimulus bills coming through that will have even more significant deficits for 2020 and presumably in the years to come. But the U.S. can print its own money, so it can meet all those obligations, but it doesn't necessarily mean that the money will have as much value if that happens. It would lead to higher interest rates and presumably less business investment and less consumption, as we've seen in other countries that have had this similar issue. But hopefully it won't turn out as bad as other places have. Let's go ahead and move on to the next one. So as we try to put the puzzle pieces together for the next two questions, what does this mean for you, and how would we try to implement this for going forward? So let's go to the next slide, Josh. These next two slides are what we refer to as jelly bean charts, because of all the different colors that are on there. But basically, these are all different types of investments and what kind of returns that they saw for the last 10 years. And what we try to point out is that nothing is always number one, nothing is always on the bottom, and it's very difficult to try and pick what's going to be the best performing investment from one year to the next. So the key word that I'm sure you've all heard is diversify or diversification, making sure you have some in all of these areas so that you're always going to have the winners, and you're always going to have a very broad investment return because you're covered in a lot of different areas. On the next chart, this one shows the different sectors of the economy, from technology to financials to healthcare. And so if you have investments, you want to make sure that you're also not just invested all into technology or all into healthcare, but you've got a good spread there as well. Because again, technology last year accounted for 50% return, which is fantastic. But what if it was going to be like another 2008 or 2009 where it wasn't so good? So anyway, let's move on to the next slide, Josh. This is kind of an interesting chart where if you're 100% stocks, I generally try to encourage people to have investments in multiple different types. So one of those obviously is stocks. This chart is showing if you were to have been invested 100% stocks for the last 45 years, the likelihood that you would have had a positive return in a 1 month period of time is about 64.5%. Over a 10-year period of time, only 93.7%. But there were still 10-year periods over the last 45 years that you would have seen a negative return. And so to increase the chances that you see positive returns over the long term, in the middle column, they want you to add bonds to that mix. And even in the far right column, you have both U.S. and international stocks as well as bonds, because there are times where the international stocks and the exchange rate that we talked about before will provide positive returns. And so over the last 45 years, there was never a time that you would have had a negative return if you had that mix. And on the top, it says 65% U.S. and international stocks. In the fine print, it tells you that it's 48.75% U.S. stocks, 16.25% international. So it's not a very large allocation to international stocks, but a little bit can go a long way. Let's go to the next one. Oh, this is one of my favorites. So if I'm very much a buy and hold long-term investor. There's obviously things that we can invest for short-term goals, but for those people who are looking at retirement, for example, buying and holding is going to be the best way to go, because if you were to try and time the market and try to figure out, okay, it's easy to look back and say, yeah, the top was on February 19th and the bottom was on March 23rd. So if I could have sold on that day and then bought on the 23rd, I'd be doing a lot better. But I mean, I went to Guatemala thinking, everything's great. If I knew that was coming, I would have called all my clients and I would have told them all to sell, and I'd take care of them when I got back. But it's near impossible to know where the top and bottom is. And as you go down the bar chart, you can see if you miss the 10 best days or the 20 best days, the value of your investment over the long term is dramatically reduced. And part of that is because the best days tend to come after the worst days. So over the last month, at least in the month of March, we were seeing days where the market came down 10%, and then the next day it was up 10%, which it's going to be one of the new best days by definition. So if that market was down 10% and I got a phone call from somebody saying they wanted to sell, they would have completely missed out on the next day, and who knows how many subsequent days until they felt ready to get back in. And that has a very significant negative impact to your overall investment return. Let's go to the next one, Josh. So just kind of an FYI, so the stock market fluctuates, and it's just important to recognize that and understand that. A little over 3 times a year, we'll see drops of about 5%. About once a year, we'll see a drop of about 10%. And then once every 3 years, we'll see a drop of 20% on average. So, it's always something. It could be a coronavirus. It could be, a financial crisis. It could be, it could be 9/11 type events that drive these market activities. But if it has more to do with headlines driving the market down, then it turns to be very good investment opportunities. If it has more to do with companies and their ability to generate revenue and earnings, then it could be a little bit more of a long-term issue and maybe a reason to start evaluating how you're invested at that time. But all right, let's move on. Next one, again, sometimes international stocks do better than U.S. stocks. I'm not sure why this one made its way in where it is, but that's just a chart showing where relative performance of U.S. stocks and international stocks. So let's go to the next one. So the final question, how do we put all the pieces together? Let's go to the next slide. So you basically just want to make sure you've got a good diversified allocation to stocks and bonds. If you invest in real estate, you can include real estate in that. If you're a business owner, you've got business investment. You can include that in there as well. Again, it's really about making sure that you've got enough assets and enough investments to survive whatever the market's going to throw at you. Let's go to the next slide. I don't know exactly why this one's in there. We can move to the next one. I'm not going to talk about that one. And let's just go all the way to the summary, Josh. I'm good to skip the rest of those. So again, in summary, we think that the risk of a recession has increased. If we haven't already started a recession, then we very well could. But we still think that the economy was doing well before the government shut everything down. And as soon as they can reopen and we can get back to work, we should be able to get back to where we were, and if not, surpass where we were, if only because we've got the low interest rates, we've got decent inflation, and the Federal Reserve interest rates are low as well, which should incentivize people to invest. Pullbacks, so the declines in the stock market, whether it's 5, 10, 20%, create very good opportunities to invest, especially if you're starting out for the first time. You can see really good returns in a very short period of time. And just to remember, if you've been investing for a while, that this is a time to stay invested, not let it get you off track and miss out on the best days. But that's it. Next question. The next slide is just for questions. So what do we got, Josh? You're muted. Josh, you're muted.
There we go. Sorry, my kids were screaming in the background. So
No, you're good.
No, Kelly just had a comment. He said that negative interest probably isn't a very good thing. And so hopefully we avoid that here.
Yeah. So I mean, again, interest rates are not my expertise, but from what I've read, it doesn't sound like it helps anything. So it basically is trying to the way it usually works. So there's a value associated with a bond, and we'll just say it's $1,000, and there's an interest rate that they'll pay you for it. On these bonds, they're paying it's a 0% interest rate, and the value of that bond is more than $1,000. And when that bond matures, all they're going to give you is $1,000. So if you give them $1,010 and you get $1,000 back, I mean you're getting money back, but you're getting less. So it doesn't make sense from an investment standpoint unless you just want the guarantee that the money's coming back. But it doesn't seem to have any positive effect for the economy to get going again. So, and I don't even know if Kelly's there. I can see his picture. Oh
no, I'm here. I just figured that that's a better view than that one. So,
Oh.
No, I had just heard that it was just as an indicator was it was not a good sign in terms of looking at the if you're kind of looking at your vitals, if you think of the economy as a living thing, that's a really bad one to see, is what I'd heard. But again, I know nothing about this.
Well, and I think, and again, and this is just kind of a personal opinion, I think that what they're trying to incentivize people to do is not put the money into a safe, quote unquote safe investment with the government, but then either go out and buy something or put it into a stock investment or somewhere else. Because, if I'm going to go out and spend the money on a car, I know that is an investment that will decline as well. So, maybe I'd be better off going and buying that car and spurring the economy that way, as opposed to just putting it into a bond that's going to get me a negative return. So anyway.
So, the long-term investment, I mean, I'm hearing a lot of people saying, hey, let's ride the storm or whatever. But what about those people that are older, that are close to retirement or just getting in retirement, and they're seeing all of their retirement go away at the moment. I mean, how long of a recovery will it take for some of these funds to get back? I've heard some people say they've seen their 401k drop almost 50%. So.
Yeah, I think that best case scenario, we're back to where we were by the end of the year. It still remains to be seen, how long this is going to play out. What's the real economic impact going to be as events and other things are canceled, through the summer. I think people are preparing for the worst, but hopefully it won't take that long. But yeah, I mean, I have clients who are both retired or they're close to retirement. And the ones that have been the most concerned are the ones who were hoping to retire, this year or next year, and they're afraid that again their investments have gone down and they won't be able to retire. But haven't heard as much concern, because it's when we go back to that whole diversification strategy, it's making sure you've got emergency savings, whether you are 30 years old, 60, 80, having an emergency reserve where you can still survive regardless of what's going on in the market for 6 to 12 months. I generally will have that longer if you're the closer you are to being retired. But then having the investment set up so that you are still producing income, whether it's through bonds or dividends from the stock investments that you have. Because those who are retired, they don't want to go back to work, or they can't go back to work, so they have to rely on the income that's coming from them. So, I try to, I do the best I can to encourage people to have that emergency fund for times like these. Not everybody always takes me up on it. So it's, the harsh reality is they'll either need to continue working, or they're going to have to, maybe reassess how much money they're going to spend when they get to retirement, or when they take Social Security, or whatever. So that tends to be a more individual conversation. Just kind of everybody's a little bit different. So, but those are generally the things that we'll look at to try and figure out how do we get them through.
And do you have any advice for people that are kind of in panic mode, like take 3 deep breaths, or?
Honestly, March was a tough month. I felt like every day I'd turn on the news and it was down 7 or down 10, or it was up 5. And it was a roller coaster that I had to be the calm voice as people were calling in, or I was making calls to them, just, trying to take a temperature. And it's just, in my position, because I've been doing it for as long as I have, like, I know things are going to work out. But when we're in the middle of it, it's very emotional, especially for those that are either close to retirement or are retired, and they want to make sure that they have enough. They remember, oh gosh, it was at this value, now it's all the way down here. And that could be the value that it was 2 years ago, and they're like, I just lost 2 years worth of investments. And so it's usually just try not to watch, which is not always easy, but that's why I'm like you. That's why you're working with me, so that you don't have to pay attention. But yeah, it's and I actually just got an email with it's kind of a marketing piece that basically kind of puts some of this information on paper, so that people can see, because as much as it means coming from me, if they can also see, historical data to back it up, or, something that they can feel and touch to put them at ease, I'm happy to share that with them and just talk them off the ledge, more or less.
Gotcha. So, we've been talking with Len Williams, who's the president of Alta Bank. We've talked with Brandon Fugel, you mentioned him earlier. So the banks in particular, are saying they're in a much better position financially to weather this storm than the last recession, where banks were failing. And so personally, I feel like that just gives us a little bit more of a buffer to be able to handle a crisis like this economically and be able to recover quicker. I've also, in talking with Brandon, he said that Utah is a little bit shielded, or it won't affect Utah as much as like the coastal cities. Just, are you seeing things like that? And obviously investments are national, global, but is there kind of any reassurance here in Utah of, okay, we're going to be okay?
So yeah, I don't look a lot at the Utah economy individually. It's more just on the national level. So I don't know if I have a lot I can comment on that one.
Yeah.
Sorry.
Any insider tips on some Utah companies we should look at?
Most Utah companies are not publicly traded, but no, I am unable to go into specifics in this point. Sorry.
Nice. Have you seen anybody actually reach out to you about these loans for businesses that the government's providing? Or
Yeah, so I've got a couple clients who have had to close their doors because of government mandates, and they've reached out to me, and I've just passed them along. I mean, it's not my business, so I try to provide them with the resources that they need. But yeah, I mean, there have been a few.
yeah. Well, maybe we can, does anybody else have any questions that you'd like to ask Austin real quick? If not, I'd like to bring Peter J on. If you're on or available. So Peter he's the president of the Business Resource Center, and he helps businesses connect with people like Austin, depending on what their needs are. There you are.
Yeah, I'm here.
So Peter, do you want to just say some of the things you're hearing from the Business Resource Center on, are there more tools coming out for the businesses? And
the Business Resource Center, I mean, we have several government agencies in our building that provide resources for businesses. We have the Small Business Development Center that's government funded. It gives free business consulting. They can help businesses apply for loans for free. I mean, they'll help you get your financial statements and everything ready, and your accounting, everything, get the applications ready. It's pretty helpful. I had one business told me that they talked to a consultant to help them fill out their EIDL loans, the SBA disaster assistance. The person was going to charge them $4,000. So that's ridiculous. It was somebody out of Vineyard that was going to charge that much money. The max you can get is $15,000. And so
can you talk a little bit about that? Because I think that's new information. A lot of businesses were thinking they could get a lot more, but now we're hearing from more and more businesses saying that they're being told 15,000 is the cap.
Yeah, for the SBA disaster assistance, 15,000 the cap. I don't know if the $10,000 emergency funding they give is part of that or added onto it to make 25,000. But I applied for my own business too. I have another side business, and I was approved for the 15,000, so I should hopefully be getting that soon. But yeah, they capped it at 15,000. If you want more, you've got to go through the PPP loans through the banks, and you can get like $2 million out of that, but it depends on your wages. So,
gotcha. And maybe Austin and Peter, maybe you can both address this, but a lot of companies do business with China. That's where they get their product from, and so how has the coronavirus and some of these restrictions on trade and travel, how has that affected that industry of being able to do business? I know that Peter, you personally had to deal with that.
I've lost tens of thousands of dollars because of the tariffs and because of the coronavirus in China. I lost money in January when it hit China because we couldn't get some workers out of China to come and work on some projects with us. And so we were already losing money because of the coronavirus in January, and then it hits here. So now we're losing money since it hit here. So we've been affected by the tariffs, the coronavirus in China, and the coronavirus in the United States. I'm sure a lot of other businesses are in the same situation.
And Austin, how does that affect the investment world, these tariffs and just dealing with trying to move product?
So the companies that I generally will try to invest in don't always have a lot of exposure to China, especially since President Trump came in. A lot of these companies will or have been moving their operations out of China and trying to diversify where they're manufacturing so that they don't have as much of a hit when it comes to the tariffs and everything as well. So I know initially some of the companies had an issue, but haven't seen as much of it most recently. And we're still, I mean, again, I think that they're all taking a hit from just the general market decline, but would still expect them to recover as things get back to normal.
Gotcha.
My wife has a business. There's the president of a business that does a lot of import. And the challenge is, well, they were paying it. I'm sure, Peter, you had the same thing then. It was in January and February is where the real pain was, because China was completely shut down at that point. Now China's flowing again. Everything is going. But now the market on this end is shut down a bit by government mandate. And so it's a challenge. And then the other problem with the diversification, because they were trying to do the same thing, move to, from even Vietnam and Pakistan of all places. But the problem is that the raw materials still came from China. And so it's until there's more diversification in the raw materials end of things, then I think we have a bit of China's still a bit of a choke point. If it goes down, then it causes a lot of problems.
I will say this too, even with all the tariffs and everything, it was still, in the business I'm in, it was still a lot cheaper to go to China than going to US distributors. So, I mean, just as a business decision, it was still a whole lot cheaper, even with the tariff rates and other fees and costs, to work with the Chinese companies, because I don't know why the US costs are so high all the time, but for the business I was in, I'm still better off that I had worked with China than I had gone with the US company.
Gotcha.
I don't know if it'll stay that way, but
Yeah, well, I think we're all learning new ways to do business through this pandemic that we're dealing with, and it'll probably create new channels of market that we didn't even think about before. Some of these industries are getting into things that they never thought they would get into. Who would have thought that General Motors would produce ventilators and respirators by the millions? But that it's all about being innovative and trying to follow the market flow, I suppose. So, Austin, any final comments before we finish up with a call here?
No, I just want to make sure people are making good investment decisions. So if you have any questions, I'm always happy to talk. But yeah, if you want me to come back in a few months and recap, I can do that too.
Yeah, definitely.
Hopefully, when we have you come back, it'll be because everybody's got tons of money again and they need to figure out where to put it.
By then it might be too late, but okay.
I'm sure we could use some more advice in a couple months there, Austin.
Definitely.
That's right.
Thank you.
Christina, you have any comments to finish up here?
No, I think that was great. Thanks, Austin. It was really informative.
All right. Well, again, we appreciate you coming on. Peter, thanks again for being a host with us on these calls. So thanks again, everybody, and hope you have a great day and a great weekend.
Thank you. Bye, everyone.